You know how everybody keeps saying the housing market's about to crash? Just wait until rates drop? That's the classic line. But here's the truth. What's coming isn't your dramatic crash with prices falling off a cliff. It's uglier because of what's already happening beneath the surface. Let's start with inventory. For years, homes were vanishing as soon as they hit the market. But now, inventory is creeping up fast. In some cities, it's back to pre-pandemic levels. Now, that doesn't sound bad at first until you realize demand isn't keeping pace. That imbalance, that's a problem. Places like Miami, Austin, Orlando, New York City, Jacksonville, Tampa, and Riverside are already shifting into buyers' markets. That means homes are sitting longer, and sellers no longer have buyers lined up at their doors. Some sellers are even yanking their listings completely. Delistings are way up, while others are quietly slashing prices. And this isn't a dramatic, headline-grabbing crash. It's a slow bleed. Sellers don't want to admit it, but the market's softening, and buyers know they finally have leverage. Now let's talk construction. You'd think builders would be going crazy right now, right? Prices are still high. Demand for affordable housing is everywhere. Seems like a gold mine. But no, builders are pulling back. Materials cost more, labor shortages are eating them alive, and financing isn't adding up. Projects are being shelved before they even break ground. And tariffs? They're quietly driving up costs by thousands of dollars per home. Add that to rising insurance premiums, and building affordable homes is becoming nearly impossible. Which brings us to another ugly factor: climate risk. Around 1 in 4 U.S. homes sit in high-risk zones for floods, hurricanes, or wildfires. Insurance companies know this. Premiums are skyrocketing. And in some areas, you can't even get coverage anymore. Without insurance, selling or even owning a home becomes a nightmare. Put this all together: more listings piling up, buyers pulling back, sellers getting desperate, builders stepping away, insurance choking affordability. What you get is not a crash, it's a gridlock. Prices don't collapse overnight, but they stagnate, inch down, and drag everything else with them. And here's the bigger picture. Housing isn't just about where people live. It's the backbone of the economy. It drives construction jobs, renovation projects, furniture sales, even small businesses tied to home ownership. When housing stalls, the ripple hits everything. So no, it's not interest rates alone. It's inventory shifts, builder pullbacks, insurance costs, affordability, and a slow bleed of confidence. That's the real reason the housing market's about to get ugly. So here's the thing about housing right now. Everybody keeps looking at mortgage rates like they're the end-all, be-all. People are like, rates drop, boom, prices shoot back up. Rates stay high, market crashes. And sure, rates matter, but that's not the full story. What's creeping up underneath is way uglier and way more complex than just the Fed playing with numbers. Let's start with inventory, because that's the foundation of the whole picture. For the last couple years, inventory was historically low. Homes went up for sale, and they were gone in days. It gave sellers all the power. But now, that's shifting. Inventory is climbing, and in some markets, it's surging. That sounds like a good thing for buyers, right? More options, more negotiation power. But here's the ugly twist. Demand isn't catching up. People want homes, sure, but they can't afford them. So what happens? Houses sit, they don't move. And here's where psychology kicks in. When homes sit too long, buyers start thinking, wait, if it didn't sell, maybe it's overpriced. Maybe the seller's desperate. Maybe I should wait for a better deal. That hesitation snowballs. Sellers, meanwhile, dig in because they don't want to admit they missed the peak. They'd rather delist than take a loss. So you get this weird standoff. More homes on the market, fewer people buying, and prices that look like they should be dropping but just hang there. That's gridlock. Now let's zoom in on sellers themselves. A ton of them refinanced during the pandemic when rates were basically free money. 2% and 3% mortgages. That's unheard of. And here's the problem. If you're sitting on a 2.7% mortgage, why in the world would you sell and buy another place at 7%? You wouldn't. You're locked in. So inventory is rising, but it's also restricted at the same time, because the only sellers who are listing are the ones who really don't have a choice. Divorce, job relocation, financial trouble, whatever it is, they're being forced into the market. And desperate sellers, that's when cracks start showing. Now let's flip to builders. People think, well, if resale homes are stuck, at least new homes will pick up the slack. Nope. Builders are pumping the brakes. Materials are more expensive, labor costs are through the roof, and financing construction isn't cheap anymore. Tariffs on lumber, steel, and imported goods are adding thousands of dollars to projects. Insurance for new builds is spiking. Builders are literally canceling projects mid-plan because the math doesn't work. That's why the supply shortage isn't magically going away. And here's the part that's hitting people harder than they realize: insurance. This is the silent killer of affordability right now. Premiums have jumped in places like Florida, Texas, California, sometimes doubling or tripling in a single year. And in some areas, insurers are pulling out altogether. That means even if you can find a house you like and qualify for the mortgage, you might not even be able to insure it. And no insurance, no loan. No loan, no sale. Simple as that. And it ties directly to climate risk. Flood zones, wildfire zones, hurricane zones. Millions of homes in America are sitting on land that insurance companies don't even want to touch anymore. Think about that for a second. If 1 in 4 homes in the U.S. is considered high risk and getting harder to insure, how do you think that plays out over time? Prices in those regions don't just drop, they collapse. And then entire local economies start hurting. But here's the other layer almost nobody talks about: renters. When buyers can't buy, they rent longer. When landlords are hit with higher insurance premiums, higher taxes, and stricter regulations, they don't just eat the cost. They pass it on to tenants, so rents climb. And when rents climb, affordability gets squeezed even more, which pushes potential buyers further out of the game. It's a cycle that keeps feeding itself. And let's not forget confidence. Housing is emotional. When people believe the market is strong, they buy aggressively, they invest, they stretch. But when people sense weakness, when they see headlines about rising delistings, price cuts, stalled construction, they start pulling back. And markets run on psychology just as much as they run on math. Once confidence slips, recovery slows way down. So what you've got isn't some explosive crash where prices fall 30% in a week. It's something messier, slower, and honestly scarier. A housing market where nobody wins. Buyers can't afford, sellers won't budge, builders won't build, and renters get squeezed in the crossfire. That's the ugly truth. So here's the thing about housing right now. Everyone's focused on the wrong villain. They keep pointing to mortgage rates like it's the boogeyman. Rates go down, we're saved. Rates go up, we're doomed. But that's way too simplistic. The housing market's problems run deeper than just the Fed cranking a dial. What's about to make this market ugly isn't just interest rates. It's the fact that multiple cracks are forming at the same time, and they're all feeding into each other. Let's back up to 2008 because everybody loves to bring it up. People think what's coming now will look like that. Banks handing out ninja loans, people flipping houses they couldn't afford, and then the whole thing collapsing overnight. But this isn't 2008. This is slower, more suffocating. In 2008, the crash came from too much supply and too much easy credit. Today, it's the exact opposite. It's too little supply, too expensive credit, and buyers stuck in a trap. Instead of a pop, this is a slow bleed. Now let's talk about inventory. On paper, inventory is rising. More homes are listed now than last year, and that should be good news, right? More choices for buyers. But here's the problem. Affordability hasn't budged. Wages aren't keeping up with home prices, plus 7% mortgage rates. So homes sit, and the longer they sit, the uglier the psychology gets. Buyers start smelling blood. They think, if that house has been on the market 90 days, maybe I should wait 90 more. Maybe the seller's desperate. That waiting game freezes the market even harder. But, and here's where it twists, sellers aren't willing to break. Remember, most of them refinanced at 2 to 3% during COVID. If you've got a $400,000 house with a $1,500 payment locked in, why in the world would you sell and upgrade into a $3,000 payment? You wouldn't. So sellers stay put. And the ones who do sell, they're usually forced into it. Divorce, relocation, financial stress. And forced sellers don't wait for top dollar. They slash prices. That's where the cracks start showing. Now zoom in on insurance. And this is where things get scary. Florida, Texas, California, premiums have doubled or tripled in just a couple years. In some neighborhoods, insurance companies are flat out pulling out. No insurance, no mortgage. No mortgage, no sale. Imagine being a seller in Miami with a house worth $600,000, but buyers can't even get coverage. Suddenly, your pool of buyers shrinks to cash-only investors, and they're not paying retail. They're paying bargain prices. That's not a soft landing. That's a collapse, but only in certain zip codes. It's like mini crashes happening all over the country. And then there's climate risk. Wildfires out west, floods down south, hurricanes along the coasts. Millions of homes are technically sitting in high-risk zones. Investors see that. Lenders see that. Insurance companies definitely see that. Over the next decade, homes in those zones are going to bleed value, not because people don't want them, but because they literally can't protect them. That's not something the average home buyer is thinking about today, but it's going to smack them in the face when they go to sell. Let's bring in builders. Everyone thinks builders will ride in and fix supply by pumping out new homes. But here's the reality. They're slowing down. Materials are expensive. Labor shortages are everywhere. Financing projects cost way more than it did just a few years ago. And every time the Fed hikes, builder math gets uglier. So instead of building aggressively, they're trimming projects, canceling developments, or focusing only on luxury builds where the margins are fat enough to survive. Which leaves starter homes, the ones first-time buyers desperately need, basically ignored. And this all trickles into the rental market. When people can't buy, they rent. When landlords face higher insurance, higher taxes, stricter regulations, they push those costs onto tenants. Rents climb, which squeezes affordability further, which pushes more people out of the buying pool. It's a vicious cycle. And here's the really ugly part. Wages aren't catching up. So you've got entire groups of people basically locked out of both renting comfortably and buying outright. That's when social pressure builds. Now let's zoom in on specific cities. Take Austin, Texas. Prices skyrocketed during the pandemic. People moving in from California, investors scooping up Airbnbs, builders going wild. Now, prices are softening, inventory is climbing, and Airbnbs are sitting empty. Investors who thought short-term rentals were a goldmine are suddenly slashing prices just to cover costs. That's a localized ugly. Then look at Florida. Insurance is hammering the market. In some areas, premiums are so high they've killed demand completely. You've got houses sitting unsold, not because people don't like them, but because they literally can't afford the insurance payment on top of the mortgage. That's a systemic ugly. And then California. Between wildfires, new rent control measures, and population decline, investors are rethinking whether California is even worth it. And when investors pull back, sellers lose their biggest pool of buyers. That's a structural ugly. And here's the kicker. Confidence. Markets don't crash just because of numbers. They crash because people believe they're crashing. In 2008, panic turned a housing correction into a financial crisis. And right now, confidence is fragile. People are nervous. They see houses sitting longer. They see friends struggling to get mortgages. They see headlines about insurance companies pulling out. Confidence breaks before prices do. So what you've got isn't one big explosion. It's death by 1,000 cuts. Inventory gridlock, insurance chaos, builder slowdowns, climate risk, affordability collapse, and shaky confidence. None of those things on their own would crash the market. But together, they're toxic.